Yeah. Hi everyone. I hope you're doing well. And today we have a very important and I think very useful lecture. And it's about delta hedging and about the Greeks. And maybe you are surprised, maybe you are wonder why the Greeks in the financial mathematics. But about this you will know later. Okay, so first I would like to remind you a brief overview of the previous lecture, and it is like our pathway. Yes, the first it was the one period binomial model, after that multi-period and replicating strategies. You remember about the other kind of option, it's American option, and the celebrated Black-Scholes formula like the main result of financial mathematics. And today the dynamic delta hedging like application of the Black-Scholes formula for the real life, for the traders and other who deals with financial market. So Black-Scholes formula. Uh, um, Black-Scholes formula, Black-Scholes model. Um, this model and formula were published in 1977, but Nobel Prize was given only in 1998. But it is like usually think first publication the famous the result, and only after 10-20 years the Nobel Prize. Our main goal, you remember, it was to model the dynamic of financial market, and we assumed that financial market consists of at least three components. First, riskless asset, it is like bond or your bank account. Second, it is stocks, and model for stocks is very um, is very complicated because the price very fluctuated, you know, all this. And the third component, very important, very vital component, it is option pricing. So the formula Black-Scholes gives us this formula. For a fair price evaluation, we just need to know five parameters. Yes, five parameters. After that, we need to substitute these parameters formula. Before, we need to compute D1 and D2. After that, this n, it is like a normal distribution, integral distribution, and that's all. About these five parameters, can you remind me what are these five parameters for this formula?
It should be a strike price. It should be
First, yes, strike price K, it is first parameters. The next,
yeah. We have time, maturity of this
time
option.
time is T, yes, time
Yeah,
to maturity. Mhm.
yeah.
The third parameters.
R is the risk-free interest rate.
Yes, you're right. Thank you.
Also we have time was set. Also N is
No.
distribution.
N
It's
is not
parameters.
parameters. No
Yeah, it's
parameters.
distribution, normal distribution. I'm just trying to, and also this sigma, yes, is
Which is sigma?
volatility
Yes.
of underlying
So
asset.
K T R sigma, and the fifth parameters.
The small t, maybe. We didn't say it.
Small t. No, it's not
Or
parameter.
S.
Yeah, you're right. And S.
It's current
S.
stock price.
No, S it
No?
is like a zero. No, maybe current for today's, yes, not for the time of maturity. It is like for
Yes.
today's. If you would like now to know to buy the option, yes, we can evaluate this price, and it's independent of the time to maturity. It should be 1 month, 2 months, 1 year, but as it is for today, for today. Okay. And the question is, what happens with the option price, so with this price, if one of the input parameters changes? For example, S changes on 1, or K changes on 1, or T, or R, or sigma. What happens with the option price? Do you understand the question? Or
If we just change any of the parameters on like one, the number one, yeah?
Yes, yes. We would like to know, yes, what happens, what happens. And for this, the result of answer on this question, we can put in the table, and we can denote this result by Greek's letter. Why? It is why we called our lecture the Greeks, yes, the Greeks. So you see delta, gamma, vega, theta, rho. And for example, what is delta? Delta, it is delta, it is the first Greek, delta. And this denotes dc respect to ds. It is like change C. What is C? It is a price, yes? We would like to know what happens with option price. So it is changing in option pricing if we change what as
Current stock price, current price.
yes. No, price, yes,
No, price now.
no, price now, maybe. And it's answer. So it is this derivative is, or is delta, is called the distribution function from D1 for option call, and this result for option put. Or we can say the delta of an option is the rate of change of its price with respect to the price of underlying asset. With respect to, yes, it is underlying asset. It is usually it is stock. Okay, and similar the gamma it is the second derivative. It is result, but it means that it is a rate of change of its delta with respect to the price of the underlying asset. Vega, it is derivatives. You see that all this result, it is derivatives C, yeah, from of C, respect to. So vega, it is derivative respect to sigma, to volatility. It is result, and this means that the vega measures the rate of change of its value with respect to volatility. Theta with respect to time, theta, yes, it is with respect to the passage of time, and okay, and rho, it is derivative respect to interest rate. Okay, so all this is called Greeks, and all this helps to understand sensitivities of the model. How to derive this formula? For example, for a delta. Let me show it. What we would like? We know what is D1, what is D2, and we need to find DC respect to DS, where C it is this formula. And if would like to find it is respect to DS, yes. So if we would like to find C respect to S, so how we can find this? For it is like two terms, yes. For the first terms, it is product, yes, product, and the first term depends on S, yes, but the second depend of S too. Do you understand, Sophia?
I think yes.
Yes. Okay. So, Volodymyr, what can I write? It is like, sorry, Mikhailo Siri. What need I write? It is like,
So it should be an uh, S
sorry,
should disappear here.
sorry. Um, mhm, mhm, mhm. Mhm. Yes, really, it is derivatives respect to S is 1, yes?
Mm-hmm.
So I need to write n from D1, yes? And after that,
Minus n d2.
uh-uh.
But d1 should be derived.
It is
So it-
derivatives from first 1 multiplied to the second plus S multiplied derivatives,
oh yeah.
yeah, from
Mhm.
n D1 because D1 depends of S. And after that, what is about the second terms? What is about this?
We should only derive
Mhm.
d2 there, and that's all.
And that's all. So it is like constant, yes?
Yes.
So we need to write minus там k tratata and derivatives, yes, derivatives. Yes, because D2 is, yes, and depends. Okay, thank you. And what we do for this deriving, first, let's find derivatives from D1, yes, respect to DS, because it's necessary, yeah? D1, it is this formula, and if we would like to find derivatives respect to S, it is like constant, yes, constant. The derivatives from logarithm is, what is derivatives from logarithm?
1 divided by n.
1 divided by no this
By this, yeah,
expression
this call
by this expression,
calculation,
so
yeah.
so it will be like k
K divided
divided,
by
yeah, by
S. Mhm.
s e to the power r там t minus t. And because it is like chain rule, yes, this function depends from S2, so multiplied by this expression, by derivatives from this expression. And derivatives from this expression respect to S, it is like, what, Sophia?
It is just multiplied by E.
Mhm.
It's
all this.
Add this all and divide it by k.
Yeah, you're right. Thank
And
you.
k is
Yes, so this crossed and this crossed, and
yes.
we have only s. So this constant, it is this constant. 1 divided by s, it is this, yes? So this result. And we see that if you would like to find this derivative from d2, it is like d1, only this instead plus minus. But the derivatives from this is 0 anyway. So first we can state that derivative from d1 and from d2 respect to ds equals this expression. Okay? Okay. After that, it is we start all these derivatives, and as Volodymyr said already, that the derivatives from this product, it is n from d1 plus s derivatives from n respect to s, and yeah, because it is like no complex function like chain rule, and multiplied the derivatives from d1 respect to ds. Yes, and from this it is similar. It is like constant. Yeah, it's again the derivatives from this function n respect to s, and multiplied for this, because this d2 depends from s. And what we can see, that we have this, and it is like from previous slides, yes? From previous slides. So from this term and this term, we can write this common factor. This it is from previous slides, and this it is rewrite. Okay, is it clear?
Yes.
Right. Thank you. Okay, and it's not the end. Because you see that we need to know what is the derivatives from function n respect to s. For this, we can write, we know that the derivatives from the integral function of distribution, it is like probability density, yes, probability density, and we can denote it like phi from d1. And we know this formula. Yes, it's a Gauss function. Yeah, do you agree? Yeah, remember you?
Of course, yes.
Yes, of course. Okay, so, density function of standard normal distribution. Yes. Okay, so the next step, we would like to compute the sum of d1 and d2 and the difference from d1 and d2. D1, it is this formula, d2 this formula. If we would like to find the sum, we see that it is plus this term, but this minus this term. So in the sum, we have only this, yes? Do you agree? Yeah?
Yeah.
Okay. But if we would like to find difference, so this minus this, what should be? What will be, maybe? What will be difference between d1 and d2? This and this. Olena, what can you say? We would like to find difference between d1 and d2. No, from this minus this, what will be? D1 minus D2, Elena.
We just
Okay.
subtract.
Uh-huh.
Yeah, so we subtract and we don't get this first.
Uh-huh. We don't have
First,
this first, yes, because this
yeah,
minus this, it is the same. So from this minus this, but it is with minus
minus
already.
minus, so
Minus
it
minus
will be plus.
plus, and it will be,
It should be not half, but 1.
yes, but
Yeah.
1. Sigma multiplied to the square
Yeah.
root, yes? So it is result, yes, really. And if we know this and this, we can find the difference of the square, of this square, yes? Of this square. What is this formula, Olena? D1 square minus D2 square different, no, equals, no, from school.
D1 minus D2
Uh-huh. Multiplied.
multiplied by D1 plus D2.
Yes, but we know minus and plus, we substitute, and we have this formula. And after that, we can find D2 square, it is this, and divided by 2, because this 2 and this 2, yeah? So we have this result. We have this result. And why we need this result? Because you remember that, because you remember this formula. It is D1 square divided by 2. So we wanted to have the expression for this. Okay. So if we consider this function, this we rewrite. Instead phi from D2, we write this function. It's normal distribution, standard normal distribution. And now instead of D2 square, it is this we rewrite, this rewrite. And we have E, yes, this exponent to this power, and exponent minus this d2 square divided by 2. And yes, it's mistake. And we remember that this it was from this if you logarithm from previous slides, so we have that it is like s multiplied phi from d1. And so the result is n d1, and we substitute, what we substitute? D1, what in this formula we need substitute, and we obtained that this equals this. So it should be this equals this from this formula. So it is 0, and we have just n from d1, no, like in this table. So if you need to know what is delta, you need just to compute d1 and find the this normal distribution function. That's all. So it's about how to derive delta. With this delta is connected our second part of our lecture. It should be delta hedging. But before, about the simple hedge. What is a hedge in general? What is this? In general, we mean hedge like investment to reduce the risk of adverse price movements in an asset. Usually, hedge consists of taking an position on a related security. So, for example, futures of option contracts. So it means that if we trade buy stocks, we need to have an option too. Hedging is a way to get portfolio protection. Yes, it is not to trade only stocks, but have option. Yes, it is, and from others said sometime we mean a risk management strategy when we say hedging. It is hedge. It's like hedging. Yes, and it is like taking an opposite position in a related asset. Okay, let me explain this through in terms of some example. First, it is not like hedge, it is what is naked and covered position. What is naked and covered position? Okay, so let's consider an example of the position of financial institution that has sold the European call option on 100,000 shares. And yes, and this company sold this call option for this amount, and it's non dividend paying stock. Okay, we assume that the stock price is from today 49, and we write this like S equals S0 equals 49. The strike price is 50. Interest rate assume that 5%. The volatility is 20%. The time to maturity is 20 weeks, and it means that in years it is 0.3846, yes? And expected return, if it's necessary, 13%. Okay. Yeah, do you understand? So we have this European call option on 100,000 shares, and the company sold this for 300,000. So for one shares it was like $3. Yeah, $3. So it's like premiums was $3. Yeah, we can compute the fair price for this premium. How we can compute the fair price for this premium if we know all these 5 parameters?
Use the formula.
Yeah,
Or
use the formula Blacker-Scholes. So we can now to open median, yeah, for example, on the Python, and substitute all these parameters, and it should be two, maybe, and it should be the Black-Scholes price 2.4. This result, yeah, is right. So 2.4, it is premium. It is like a fair price, yes, a theoretical price according Black-Scholes formula. But $3, it is market price. So this company can say, oh, it's good, it's nice. Yeah, this option was over evaluated. Yeah, and it is like difference but it's not like profit. Yes, it is no like difference. Yeah, do you understand? No, it is if we compare with theoretical price, but it is no. It's not very important. Okay, but it is like example from real life, so it should be, it can be. Okay, now about strategy. We said that we would like to tell about a naked position and covered position. So first, naked position. What is this strategy? What does this strategy means? Naked position means to do nothing. Okay, to do nothing. It means that we trade. It's a strategy that works well if the stock price is below 50 at the end of the 20 weeks. So today the stock's price is, do you remember how much? Today's 49, yeah? 49 and K50. 49 and K50. Yeah, so it's about call option, about call option. So today is 49, and there are two scenario, yeah. And the strike price is 50. Strike price K is 50. And we need to consider this two scenario. No, for example, this 50, 55. No, it doesn't matter now, but okay. So this strategy, if the stock price below than 50 at the time of maturity, in this case, the call option cost nothing. Yes? Why? Because what is payoff function in this?
Because K minus S is because we choose maximum of
Yeah.
null and
Yeah.
K minus S.
Yeah. You're right. Yes. So, but now we are a financial institution that issue this option. So we don't need to pay nothing. And what is our profit? But you remember, we bought this call option and we get this amount, yes? So it's our profit. Yeah, it is in this scenario, So in this scenario, our profit, yeah, do you agree? No? Can I explain again, maybe? We are financial institution, okay? Okay. We issued this this call option, and we sold it, and we have this amount of money. And in the time of maturity, we see that this call option costs nothing. So all this money remains like our money. Understand now?
Okay.
Okay,
Now understand.
yes, understand. Yes, but what should be if this price will be more than 50 in the up scenario? In up scenario, for example, 55. The financial institution in this case needs to pay everyone how much? Per your function, yes? How much in up scenario?
5.
5. So we need to pay 5 for every shares. So it is 500,000, but it is we need to pay. So it is our loss. Yes, it is with minus. But our profit, this, because it is, no, before trading, yes, before trading, the people bought these shares. So 300 minus 500, yeah, you see, it is with minus. We have our profit with minus. It is our loss, yes, 200,000. Do you understand about naked position? Yeah, so naked position mean that we trade only option before stocks, before anyone else. And in this case, in the up scenario, it is bad for us because we have negative profit loss. But in this scenario, it is we have profit. Yeah, Volodymyr, understand what can you say? Is it clear? No? Guys. Guys.
We need some time to comprehend it. Yeah.
I can explain. Okay, if you want, I can explain in Ukrainian. Yeah? Do you like? Do you want?
I think it's okay. We just need to maybe rewatch the recording and understand it
Yes,
better.
because
Yeah.
this money, it is for issue, yes?
Mm-hmm.
For issue. So it is like unconditional. But after that, we can consider two scenarios. In this scenario, every person who has this stock price, who has this call option, says, "Oh, my call option win," and we need to pay him this difference 5. Yes.
Mm-hmm.
So we don't have profit. Yes, this minus this. Okay.
Yeah. Now it's a little bit more clear.
Uh,
Maybe more examples will help in the future.
yeah, but it is no. I don't have more example. It is like the most simple example
Okay.
and the most general. That there are
Mm-hmm.
only two scenario. Only two scenario. One scenario when this call option wins, and other scenario where this call option doesn't win. If this call option wins, so we need to pay every person the sum of $5, but 5 multiplied 100,000, it is this sum. So yes, so you remember if we win in this scenario, so the financial institution losses. Yes. Okay. Okay, maybe the next example, it is like covered position. A covered position, it is we can consider this like hedge. Because covered position involves buying 100,000 shares. So we are the financial institution, and we buy 100,000 shares as soon as our option has been sold. Okay, so if the stock price today is 49, and on up scenario, no, for example, 58, and for example in the down scenario, for example 40. Okay, so but now we have not only option but stocks. And we need to consider our profit about stocks and about call option. So if the stock price goes on over 49, for example, 58, option is exercised. Yes? No, like in previous example. And this strategy works well because why? Because about stocks trading, stock trading, our profit, it is different between 58 and 49. So if we consider stocks trading, stocks. So for one stock, our profit is how much? How much our profit? Olena.
Okay, so we have 9.
9, yes.
Yeah.
This, yes. 58, this 49, so our profit 9. Our profit 9, but multiplied by 100, and we have, okay, and we have 200,000. Yes, our profit. Our profit 200,000. This on stock trading. Stock trade. What is about option? Option. The strike price is 50. Strike price is 50. So your function is 8 in the up scenario, and yes, and 0 it's the down scenario. Yeah, 8 the up scenario, and how much? No, it is the difference 8. Yes, so it is about option, call option. Okay, call option. Call option. It is 8 multiplied by 100, but it is we need to pay this money, so it is with minus. We need to pay 100,000 for call option, but unconditional. We have this sum, yes, because we said that we sold on this sum, so it is with plus. So 800 and 300, it is minus 500. Yes, you see this?
Yeah.
So if we are speaking about stock, we win. Yes.
Yep.
If we can see about call option, we lose. So in the sum, it is 900 minus 8 and plus 3, so it is our profit. It's our profit. But now we would like to consider this scenario, down scenario, when the price drops at 40. So what we can say about stock trading? It was 49, but now it's 40. So we lost how much?
Again, 9.
Yes, 9 for one share, but we have 100 shares, so it is will yes,
900,000, yeah.
yeah. But what is about option? Option call option in this scenario cost nothing. Yes, nothing. So we don't need to pay anything. And we have 3,000 or 300,000 like unconditional, yes, unconditional money. But this with plus, but this with minus. So in this down scenario, we lose. Okay?
And we lose 600,000.
Yes, you're
Okay.
right. 600,000. So you see that even we apply covered position, and it's called hedge, yes? In one scenario we win, but in other we lose. Okay, so it not very well. Okay, yes. So it is like this summary. We can assume that it is not a good option for us. Not a good hedge. Yes, not a good hedge. Yes, and what we can consider like a good hedge, it is, but you understand that a good hedge, it's not free. It costs something. So the good price for good hedge, it is like the fair price for Black-Scholes premium fair price. Yes, no, it's multiplied 100. Okay. There are other interesting hedging strategy. It calls stop loss strategy. This hedging strategy involves buying on unit of stocks as soon as it rises above K and selling like a price falls below K. What does it mean? Yes, so we know the strike price curve. No, we assume we choose the strike price, and we follow for this price, and only this price more or below this K, we need to buy or to sell our stocks. Yeah, buying, selling. Yes, in this situation.
But
Stocks.
wait, at this point, we are buying our stocks when they are greater than our K
Uh,
or not?
please repeat your question.
Okay, so when do we buy? Yeah.
When
What is this?
do we buy stocks?
Yeah, yeah.
Buying at time T1 and selling at time T2. We buy because we think that we can. No, it is no this price.
It
So it
grows,
is
yeah.
yes. No, it is like what stop loss strategy.
Okay,
But
okay.
we don't need this strategy, maybe some elements. Most traders, most, so it's not unique, use more sophisticated hedging schemes, and it's calls, no, it's like calculating delta, gamma, vega, and it will be like delta hedging strategy, And now we consider the dynamic delta hedging. Okay. According Black-Scholes model, we need to formulate the riskless portfolio, consisting of delta or of option and stock. So we need to have in our portfolio like option as stock too, and stock this amount, and plus mean that we bought and waiting, yes, and minus mean that we sell, we are selling, and we are selling stocks in and this amount we need to compute like this delta for call option. Okay. Now I explain in terms of this example. So if we would like to make this dynamic delta hedging, first we need to set all these parameters. It is like time, strike price, interest rate, and all these 5 parameters. So you remember in our example, yes, that we have 20 weeks. Yeah, do you remember this 20 weeks? Yes, it is this example. No, this, yes. 20 weeks, it is this part of years. And this 49 and strike price 50. All this we use in this example. Okay, so today we know about all these parameters, and we see that on the side, on the Nasdaq, the price for today 49. Okay, 49. We need to compute delta. You know that we can do this using Median. Okay, Median. We can by calculator. Yes, it is. We need to compute D1, yes, and after that to find the probability, no, density or normal, standard normal function from D1. So compute delta 1. And it means that we need to buy this amount of stocks. So 0.522 we multiplied by 10,000 of shares from our example. Okay, so today we buy this amount of stocks, and how much we need to pay for it? It is this multiplied to this. Yes, it is amount, number of shares. It is like stock price for today. So it is this sum. Do you agree? Is it clear for this moment, guys?
I guess
Yes.
so.
Yes, Volodymyr, are you here? No, Volodymyr, no. but Volodymyr, no, but Volodymyr, Artem, Dmytro, Mikhailo.
Yes, it's clear.
Yeah, okay, thank you. Yeah, okay. And we suppose that we don't have our own money, So this money we need to borrow, okay? Why? It is because we would like to compute the net profit, our net profit. Agree? Yeah, is it clear? Yeah.
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 Yeah. Okay. So it is like yeah. So it is like we borrow, and if it sum for all these weeks will be 240 thousand, it will be okay because it should be like fair price according Black-Scholes formula. Yeah, it is like good hedge costs like from Black-Scholes formula. So it is yes, our debt, and interest rate 5%. So for every week we need repay this sum. Yes. Yeah, this sum. Yeah, yes, this sum. It is this for a week, but we have for this sum it will be two no this multiplied this, and it should be 2.5. Is it clear?
Yeah.
What happens? Yes. Okay, so today on the Nasdaq side, you see the stock price is 49. We compute delta, and according delta, we bought these shares, and the common sum, it is amount by price, it's this, but all this price, all this amount is our debt. So at the end of week we need to pay this sum. Okay. Yeah. And now we would like to consider what will be next on the next week. On the next week, we see that the price drop out. Yes, drop out. We computed delta. Using median, for example. Using median. After that, we need to find this difference between this delta. So it is 0.458 minus 0.522. Yes, and it should be how much?
0064?
Yes, 0.064. Yes,
Yeah,
and
minus.
yes, and it's with minus. This different with minus. And in this example, what is minus? I write in the bracket, but it means that with minus, And what? And if we have something with minus, it means that we need. What do you think? With minus, we need
We sell it?
yes, to sell. So on the previous week, you remember, we buy this amount of shares, but now when the stock price drop out, we need to sell, but not all these shares, only part of these shares. And how much? How we can know what is part of shares we need to sell? It is like the difference of deltas. So exactly this. And if we sell this on this price, so we get this sum. Yes, we get this sum.
Yeah.
Um, but yes, and our debt is less because it is no we obtain this money. Yes, we obtained this money, so our cumulative debt now is less than before. Yeah, do you understand?
Yeah, we sold this and
Yes, and
returned from our debt.
yes, and at the end of the year, it is we need to pay interest rate, and it is this. It is this. After that, you see this price. It is the dropout again. So we compute delta, the difference between this delta, no, this and this with minus, and it should be 0.0, yes, 58. Yes, it is with minus, it is sum, and so all. After that, for example, on the next week, the price goes down. So difference between 0.596 and 0.400, yes, it is with plus. So, okay, so we need to buy stocks, yes, to buy. So to buy, to sell, to buy, to sell. So this hedging strategy shows you how much we need to buy or how much we need to sell if the stocks price changes. Okay. And what we have at the end on this week, um, you see that the price was 49, and at the end we have that the price 57. So it is, but strike price was 50. So you see that the stock price more than strike price. So we are in the money, okay? We are in the money. It is two scenarios. There is other scenarios when the stock price is below than 50, and in this case we out of the money. Okay, is it clear? This two scenario, yes. So in this scenario we are in the money, and you see that delta at the end of the 20 weeks is tends to 1. It is no 1.000. It's exactly 1, yes. But in this scenario, a delta at the end is 0. Yes, it's interesting. And you see that at the end of year, we don't need to buy or to sell anything. Yes. And how much, what we have at the end of 20 weeks? How much? How much? For this, we need to find the sum for this column. So it is with plus, it's with minus. It's with plus, it's with minus. I can say it where this. Cost of repay, interest cost, cumulative cost to repay. It is this. At the end of the 20 weeks, we bought this number of stocks and sold this number of stocks. So at the end, we owns 100,000 of shares. Yes. Yes, how we can find this? How we can find this? Do you understand? How we can find this? Huh?
Delta.
Yes, we need only to add this minus this plus this plus this first with without bracket with plus, and after that with brackets, so it means with minus. So it should be that we bought this amount of stocks and sold this amount of stocks. So this minus this should be 100,000 shares, and 100 yes, and we have 100 shares and this price. So we multiplied this price by 100 shares, and we have this profit. This profit, it is on stocks, but what is cost for this hedge? What is cost for this hedge? It is, yes, you remember that we didn't have our own money, so it was our debt, and our debt was less or more sometime, yes, and at the end of 20 years it is our debt. You see? You see? Okay, so we need subtract from our profit our debt, and we have the profit. It is more or less than this, yes. But anyway, we have this profit. It is profit from stocks, yes, trading, from shares trading. It's the same. Okay. Um, Sometimes, no, and now I would like to add that this strategy involves the trading buy call options, but not always you have this possibility to trade buy call options. But this possibility to trade, for example, by currency, you get already, yes. It's the usual deal, yeah. So you can use this strategy, for example, if your financial institution said that please write the program which can automatically to say us in which moment we need to sell our currency and how much, and what is moment when we need to buy currency, if and what is amount. Do you understand this value, this table?
Yeah, yeah.
Sophia, Artem,
Yes.
Yes.
yes, yes. But if you have possibility to trade by option, it's fantastic. But yes, but you understand that it can be always. In this case, as holder of call option, what will be if this in the money? Yes, it is in the money. In the money we have in the money. So. The strike price 50, so the profit on one shares it is 7.25, and we have 10,000, so it is as financial institution we need to pay this sum, but he earns premium this, so it is like lost. But if we compare the profit from stocks and the loss from option, so it is net profit is positive anyway. And the second example option closes out of the money, out of the money. Okay? And the summary, it is, and all this hedging strategy was considered with investor or with financial institution point of view. But you can consider it from investor points of view too. And summary, we can say that if the assumption underlying the Black-Scholes formula hold, the cost of financial institutions should always be 240,000 on average for both approaches. It is like good hedge, good hedge. The cost of hedge with discount, yes, no, it is the same. It is the same. Okay, so that's all what I would like to tell you today. And I think that if you have any question, you can ask now, or we can consider it on the practice lesson. What do you say,
I
Hylo?
have one little question.
Yeah.
Where we get the stock price,
Uh-huh.
I talk
Uh-huh.
about this historical data prices or this prices for example, yesterday. Or these stock prices, or for
This,
example, we have,
yes,
yeah,
yes.
for example, we have 52 for second week. Uh, from what we get this price? From historical data or maybe
No,
others?
in these examples, it is like today we have this, after 1 week we have this, and no, not historical. Like it is like should be future. Now we can consider these prices like historical. Yeah, but if we apply this strategy, it is like the first value, this it is on the future, next week will be, it is next week, so it should be a different value. We don't know in advance what it should be, at the money or out the money at the end of 20 weeks. Yeah. Maybe you would like to ask something else. Maybe I didn't understand your question. No?
I understand.
Understand? Okay, thank you. So I wait you at 3 p.m. Okay?
Okay.
Okay, thank you. Thank you
Okay,
for your
bye.
attention.
Thank you.
Yes,
See
bye,
you.
bye. See you.